If you look at the corporate software landscape right now, I mean, it is basically completely divided into two camps.
Yeah, completely split.
Right. So on one side, you have these companies that are just absolutely terrified that artificial intelligence is going to, replace them entirely, just rendering their whole user interface obsolete.
Right, playing total defense.
Exactly. And then on the other side, you have companies that are basically going broke trying to run these incredibly expensive AI chatbots that, let's be honest, their customers frankly do not want to pay extra for.
Yeah, the compute costs are just eating them alive.
They really are. Yeah. But buried inside this Q1 2027 earnings call for Box Inc., which is a company that, most people probably dismissed years ago as just a boring legacy digital filing cabinet, is the blueprint for the exact opposite. Right. They are not getting replaced by AI, and they are definitely not losing money on it. I mean, they have somehow built this money printing machine right in the middle of all this technological chaos. So welcome to our deep dive. On Talk Tickers, our whole mission is to bring you this data-forward, plain language breakdown of corporate earnings. We translate the Wall Street jargon so you, the retail investor, can actually make sense of it.
And this specific transcript is just a remarkable divergence from the rest of the industry. I mean, what we are seeing here is a company executing a massive, somewhat hidden pivot.
Yeah, hidden is the right word.
Right, because Box is no longer just, a place where you drag and drop your PDFs when your hard drive gets full. They are actively transforming themselves into the foundational, intelligent content management infrastructure layer for the whole AI era.
Which sounds like a lot of buzzwords, but it actually means something very specific here.
It really does. They are positioning their platform as this critical bridge that sits directly between a corporation's raw, messy, unorganized data and the highly sophisticated AI agents that are flooding into the workforce right now.
Yeah.
It is a fundamental rewiring of their identity.
Yeah.
And honestly, more importantly for you, if you're looking at the stock, it is fundamentally changing how they generate cash.
Right. And we are going to look at the exact mechanics of how that cash is being generated because the numbers here are just staggering. But before we get to the AI stuff, we have to look at the raw scorecard, to see if Wall Street is actually buying this transformation.
Because the narrative doesn't matter if the numbers don't back it up.
Exactly. So, okay, let's unpack this. The massive headline that jumped right off the page from CEO Aaron Levy's remarks is the Q1 revenue. They hit $306 million.
Which, is a solid absolute number. But in software, absolute numbers don't really drive valuations.
Right. Nobody cares about the absolute number. They care about the growth.
Exactly. The market cares entirely about the trajectory. So that $306 million represents an 11% year-over-year growth rate. Or if we look at it purely operationally in constant currency, it's 10%.
Wait, let's hold right there and contextualize that 11%, because for anyone who has been tracking this stock, or really this whole sector, breaking into double digits is not just a rounding error. I mean, it is a massive psychological and financial milestone.
Oh, it is arguably the most important metric in the entire earnings report. This is Box's first double-digit revenue growth rate in over 12 quarters.
Over 12 quarters? That's wild.
Yeah, think about that timeline. That is 3 full years of being stuck in what you might call a single-digit growth purgatory.
And why is that purgatory so hard to escape? I mean, because once a software as a service or SaaS company dips below that 10% growth line, Wall Street basically completely rewrites their narrative.
They absolutely do.
Right. They stop looking at you as an exciting, high-growth tech innovator, and they start treating you like, a legacy utility company. You basically become a telecom or a water company in the eyes of investors.
Yeah, the multiple that investors are willing to pay for your stock just collapses. Because in SaaS, growth solves everything. When you are growing at 20 or 30%, investors will forgive thin margins or super high spending because you're capturing market share.
Right, you're grabbing land.
Exactly. But when you drop to 6 or 7% growth, the market just assumes you have saturated your total addressable market.
Yeah.
They assume your product is a commodity and you're just competing in this race to the bottom on price.
Yeah, and for Box, competing against giants like Google Drive or Microsoft OneDrive, that single-digit growth signaled to the market that standalone storage was basically dead.
Right, so breaking back through that 10% barrier, effectively re-accelerating the business after 3 years is incredibly rare. Right. Companies usually just do not find a second act of growth once they stall out like that.
And what makes it even more shocking, I think, is the current macroeconomic backdrop. Every other software company's earnings call sounds like a funeral dirge right now.
Oh, it's brutal out there.
It is. They are all complaining about how tight chief information officer budgets are, how the hiring environment is just completely muted, and how massive enterprises are actively trying to rationalize and consolidate their software spend.
Yeah, everyone is trying to cut tools, not add them.
Right. So to suddenly find a second act and accelerate growth right in the teeth of a brutal corporate spending environment, that tells me that whatever Box is selling is no longer viewed by its customers as optional.
That is the crucial distinction right there. It has moved from a nice-to-have collaboration tool to a must-have piece of core infrastructure. But we have to be careful here because revenue is technically a lagging indicator.
Right. It tells us what happened in the past.
Exactly. To understand if this momentum is real, we have to look at the billings.
Okay, yes. And here's where I really want to pause and make sure we unpack the mechanics for you listening. Because revenue and billings are often used interchangeably by casual observers, but CFO Dylan Smith treats them very, very differently in this transcript.
Yeah, they are fundamentally different concepts in SaaS accounting.
Right. So let's make this concrete. If I think about this like a restaurant business, revenue is the act of eating the meal. I consume the food, the restaurant provides the service, and they recognize that value on the books. Billings, on the other hand, is like me buying a gift card.
I love that analogy.
Right. I am putting cold, hard cash into the restaurant's register today for meals that I intend to eat over the next 12 months.
Yeah, that analogy perfectly isolates the accounting mechanics. Because revenue recognition in SaaS is ratable.
Meaning it's spread out.
Exactly. If a massive multinational corporation signs a 12-month, $1.2 million contract with Box today, Box does not get to claim $1.2 million in revenue for Q1.
Even though they got the cash.
Even though they got the cash. They only get to recognize 1/12 of that amount, so $100,000 for the first month of service provided. The revenue trickles onto the income statement slowly over the year.
But the billings capture that whole gift card up front.
Yes. Billings represent the actual invoices sent to the customer for immediate payment. So if that same customer is invoiced for the entire year up front, that full $1.2 million shows up in Q1 billings.
Which is why the street cares so much about it.
That is exactly why the market obsesses over billings. It is the leading indicator. It measures the pure velocity of the sales team right now. It tells us, how many new contracts were signed and how many existing contracts were renewed and expanded in this specific 90-day window.
Right. So looking at the gift cards purchased, so to speak, Q1 billings came in at $255 million. That is officially a 5% year-over-year increase. But again, Dylan Smith spent a lot of time on the call talking about constant currency, which kind of completely changed the complexion of that number. What actually happened beneath the surface there?
Well, we have to remember that Box is a global operation. They're heavily exposed to European and Asian markets.
Right.
So in constant currency, meaning if foreign exchange rates had remained exactly the same as they were a year ago, billings actually grew by 13%.
Wait, let's break down that foreign exchange drag because 5% reported versus 13% operational is a massive discrepancy.
It is huge.
So basically, when the US dollar is very strong relative to the euro or the Japanese yen, Box still collects the same amount of euros from their German clients, right? But when they have to translate those euros back into dollars to report their earnings in the US, those euros just buy fewer dollars.
That is the exact mechanism. And Dylan Smith explicitly noted that they faced an unexpected foreign exchange headwind of roughly 260 basis points.
Okay, and for clarity, a basis point is 0.01%.
Right, so 260 basis points means the currency drag was 2.6% worse than they had internally projected just 90 days ago.
Wow. But despite that massive unexpected penalty from the global currency markets, they still crushed their own guidance.
Oh, they demolished it. I mean, they had previously guided the street to expect low single-digit growth for Q1 billings, to absorb a 2.6% unexpected penalty and still post 5% reported growth and 13% operational growth. That means their sales floor was closing deals at a significantly higher volume than even the executive team thought was possible at the start of the quarter.
Yeah, that's incredible.
The underlying demand is far outpacing the macro headwinds.
Demand is great. But, in the era of high interest rates, growth at all costs is a dead strategy. Like, you can't just sell dollar bills for 90 cents anymore and make it up on volume.
No, the market will punish you for that now.
Absolutely. So we have to know if this underlying growth is actually translating into profitability. Looking at the bottom line, the earnings per share, or EPS, came in at 37 cents. That beat their internal guidance of 36 cents. But EPS can be manipulated, right, with tax rates and one-off accounting tricks. To see the real health of the business, we have to look at the margins.
Yeah, margins are the ultimate truth teller in software because they reveal two very important things: pricing power and operational efficiency.
Okay, let's start at the top with the gross margin.
Right. In Q1, Box reported a gross margin of 81.5%. That is up 100 basis points from the same quarter last year.
Okay, let me play the skeptic here for a second. 81.5% sounds high, but what does it actually cost a company like Box to deliver its product? Like, I want to break down the physical mechanics of a gross margin for a cloud company, because for every dollar Box takes in from a customer, 81.5 cents is considered gross profit.
Right.
That means it only costs them 18.5 cents to physically provide the service. What is in that 18 cents?
Well, for a SaaS company, the cost of goods sold at 18.5 cents is primarily the raw computing infrastructure.
Like servers and stuff.
Exactly. It's the massive server farms they rent from Amazon Web Services or Google Cloud Platform, the electricity, the cooling, and the basic customer support required to keep the literal lights on and the data accessible.
So they spend 18 cents on servers, and they have over 81 cents left over to pay their software engineers, their marketing teams, their executive salaries, and ultimately, to generate profit for the shareholders. I mean, that is an elite tier of gross profitability.
It really is.
But I assume you were going to tell me that the real magic happens further down the income statement.
It does. Because while 81.5% gross margin is fantastic, what's fascinating here is the operating margin. That is where we see how well the company is actually being managed.
Because that includes all the other expenses.
Right. Operating margin measures profitability after you pay all those expensive software engineers, the aggressive sales teams, the marketing campaigns, and the corporate overhead. Their Q1 operating margin came in at 27.7%.
Wow.
Yeah. That beat their guidance of 27.5%. And more importantly, it is a 140 basis point expansion from the previous year.
Wait, hold on. If revenue grew 11%, but operating margin expanded by 140 basis points, that means their profits are growing faster than their sales. How does a company actually achieve that? Like, practically speaking.
The term for that is operating leverage. It basically means the business model is highly scalable.
Wow.
You see, in the early days of a tech company, to get 10% more revenue, you usually have to hire 15% more salespeople and spend 20% more on Google ads. You are essentially buying your growth.
Right, the brute force approach.
Exactly. What Box is demonstrating right now is that they can accelerate their revenue growth without proportionally increasing their headcount or their marketing spend. The product is becoming stickier, the deals are becoming larger, and the cost to acquire and serve those customers is just flattening out.
And that operational discipline just flows straight down to the actual bank account. I mean, they reported a record free cash flow of $128 million for the quarter, up 8% year over year.
Huge number.
So when we synthesize this entire first section, the takeaway for you listening is not just that they beat earnings by a penny, it is that they delivered a pristine, comprehensive beat across every single metric that matters.
Across the board.
Right. The top-line revenue re-accelerated, the forward-looking billings defied currency headwinds, the gross and operating margins expanded massively, and the business generated record cold, hard cash.
It is a flawless quarterly scorecard. But, as pristine as those numbers are, a spreadsheet doesn't explain causality.
Exactly. And this is where we have to dig deep. Because frankly, looking at a 20-year-old digital storage company that has been stuck in the mud for 3 years, suddenly putting up these kinds of numbers, it makes me incredibly suspicious.
Yeah, it's fair to be skeptical.
How did they do it? Like, what is the actual mechanism driving this sudden burst of high margin growth?
Oh, now understand the why. We have to look closely at the product mix. According to both Aaron Levy and Dylan Smith on the call, The primary engine pulling this entire financial train right now is a specific product tier called Enterprise Advance, or EA.
Okay, Enterprise Advance.
Right. They essentially attributed almost all of the upside surprise in the quarter to the massive momentum of existing customers upgrading to this new EA tier.
All right, let's scrutinize this Enterprise Advanced tier. Management notes on the call that EA commands a massive 30% to 40% price premium over their old top-tier offering, which was called Enterprise Plus.
That's right.
I have to push back here, and I'm going to push back hard. Because if I am a chief information officer at a Fortune 500 company right now, my mandate is to cut costs. Storage is a pure commodity. I mean, it is cheaper than dirt. I can go to Best Buy right now and get terabytes of physical storage for under $100.
Right.
And Amazon and Google are practically giving away cloud storage for pennies. Why on earth am I going to my CFO to ask for a 40% budget increase just to store my company's files on Box? It makes zero logical sense.
If it were just about storing files, you'd be absolutely right. They would be laughed right out of the CFO's office. But here's where it gets really interesting. They are not selling storage anymore.
Go ahead.
They are selling the ability to unlock unstructured data. And that is the absolute crux of Aaron Levy's entire thesis for the next decade of this company.
Okay, unstructured data. This is a term that gets thrown around a lot in Silicon Valley right now. We need to define exactly what that means and why it is suddenly the most valuable asset in the world.
Sure. Let's break down corporate data into two buckets.
Okay.
The first bucket is structured data. Think of an Excel spreadsheet, or a pristine SQL database, or the neat rows and columns inside a Salesforce customer relationship management tool.
Right, the neat, categorized filing cabinet.
Exactly. It has strict rules, it is perfectly organized, and traditional computers can read it instantly. But structured data only makes up roughly 10 to 20% of a corporation's total information.
Really? That low?
That low. The second bucket is unstructured data. This is the messy stuff. It is the thousands of pages of PDF legal contracts, the scanned vendor invoices, the employee HR handbooks, the marketing videos, the recorded Zoom calls, the raw PowerPoint decks.
Oh, wow.
It is massive, it is chaotic, and it makes up 80 to 90% of the information universe inside a large enterprise.
It's basically the dark matter of the corporate world. It is everywhere. It takes up massive amounts of space, but it is incredibly difficult to actually interact with or analyze at scale.
Exactly. And, for decades, that wasn't a huge problem. You just hired armies of junior analysts and paralegals to manually read those PDFs and pull out the relevant information when you needed it.
Right. Throw human labor at it.
Right. But enter the artificial intelligence revolution. Suddenly, every CEO and board of directors in the world is screaming at their IT departments to deploy AI agents to make the company exponentially more productive. They want a chatbot that can instantly summarize their risk exposure across all their vendor contracts. They want an AI agent that can automatically onboard a new client by reading their financial history.
But here's the massive bottleneck. If I go to a generic off-the-shelf AI like ChatGPT or Google's Gemini, and I type in a prompt saying, summarize my company's Q3 marketing strategy and tell me where we are vulnerable, the AI has absolutely no idea what I'm talking about.
Zero idea.
Right, because it might be the smartest artificial brain in the world, but it doesn't have access to my company's specific proprietary files.
Precisely. The AI is utterly useless without context. And this is the exact problem Levy is solving. He stated on the call that decades of legacy, fragmented, on-premise content management systems are the single biggest bottleneck to corporate AI adoption.
Ah, I see.
Think about a massive global bank. Their contracts are scattered across dozens of old legacy servers in some basement in London, various disjointed SharePoint instances, and individual employees' local hard drives. If your unstructured data is scattered and disorganized like that, you cannot deploy AI. It is physically impossible.
So Box comes in and says, we are the bridge.
Yes, they are telling enterprises, move all of your unstructured data into our centralized secure Box cloud. If you do that, we will provide the secure infrastructure layer that allows these highly intelligent AI agents to actually read your data, understand it, and act on it.
But wait, I'm going to push back again here. Let's look at the competitive landscape. Microsoft offers Copilot. Google has Gemini integrated right into Google Workspace. If I am a CIO, I'm already paying Microsoft millions of dollars a year for Office 365, and Microsoft is aggressively forcing Copilot down my throat, telling me it will read all my Word documents and Excel files.
Right.
Why am I paying Box a 40% premium when Microsoft claims they already have this solved?
That is the most critical question.
Yeah.
And it is the exact pushback every Box salesperson faces every day.
I bet.
The answer comes down to fragmentation and neutrality. Yes, Microsoft Copilot works brilliantly if 100% of your company's workflows exist purely inside Microsoft Word and Excel. But in the real world of global enterprise, that is never the case.
Almost never.
Right. A massive logistics company might have their financial data in an Oracle database, their customer data in Salesforce, their design files in Adobe, and their legacy contracts in some custom-built proprietary app.
So they are a totally heterogeneous environment.
Exactly. Microsoft's AI wants to keep you locked inside Microsoft's walled garden. Google's AI wants to keep you inside Google's walled garden. Box's thesis is that enterprises want a neutral governance layer. Box integrates with Salesforce. It integrates with Adobe. It integrates with Oracle. They are arguing that they are the only platform that can centralize the unstructured data from all of these disparate software ecosystems, apply a single unified layer of enterprise-grade security and compliance, and then let the AI interact with it safely.
Okay, that makes sense. If you are a multinational bank, you do not want your highly sensitive compliance data living inside a black box Microsoft AI model that you can't control. You want the data in a neutral vault, and you want to carefully monitor exactly how the AI accesses it. So Box isn't selling a digital filing cabinet. They're selling the central nervous system for corporate AI governance.
Right.
And that absolutely justifies a 40% premium.
It does, because the only alternative for that CIO is to hire incredibly expensive consulting firms like Accenture or McKinsey to build custom hard-coded data pipelines for every single AI use case they want to deploy. That takes years, costs tens of millions of dollars, and is an absolute nightmare for security and data privacy.
Yeah, that sounds horrible.
Right, but Box provides that infrastructure out of the box.
No pun intended.
Exactly.
Okay, let's look at the specific tools that actually make up this enterprise advanced tier, because Levy spent a lot of time highlighting the exact mechanisms that are driving this adoption. During the Q&A portion of the call, an analyst asked about specific use cases, and Levy explicitly called a product named Box Extract their, quote, killer app right now. I want to know exactly how Box Extract works. Walk me through a granular real-world scenario.
Sure. So Box Extract is designed to solve one of the most painful, expensive, and manual corporate problems in existence. Imagine a massive global law firm. Every time they take on a new corporate acquisition, they have to process maybe 10,000 different non-disclosure agreements, vendor contracts, and employment records.
Okay.
Historically, human beings, usually very expensive paralegals, had to open every single PDF, read through dense legalese, find the critical information like, the specific governing law, the liability cap, and the termination date, and manually type that metadata into a structured database.
It's just soul-crushing manual data entry.
It is. It takes weeks of billable hours and is highly prone to human error. Box Extract eliminates that entirely, uses custom AI models to automatically scan massive, chaotic dumps of unstructured documents. You just dump the 10,000 PDFs into a secure Box folder, configure Box Extract to look for those 5 specific variables, and within minutes, the AI reads every document, understands the context, pulls out the exact liability caps and termination dates, and populates a pristine, structured database with high accuracy.
Wow. So it literally acts as an alchemy engine. It is turning messy, useless digital paper into highly structured, searchable, actionable data that the business can immediately run analytics on.
Exactly. The return on investment for the customer is immediate. They save hundreds of thousands of dollars in paralegal hours on a single transaction. But Box Extract is only half of the equation.
Okay, what's the other half?
They're combining that extraction capability with a brand new workflow engine called Box Automate, which they actually just made generally available. Box Automate allows a company to build custom, complex workflows that route tasks back and forth across human employees and AI agents.
Okay, I want a step-by-step breakdown of how Box Automate actually works in the wild, because this sounds incredibly futuristic. It's not just the AI acting in a vacuum, it is collaborative human-machine interaction. Give me the exact mechanics of a workflow.
Let's use a highly regulated industry. Think about the client onboarding process at a major wealth management firm. The high net worth individual wants to open a trust account. Step 1. The client securely uploads a massive 200-page PDF containing their entire financial history, tax returns, and real estate deeds into a secure Box portal.
And in the old days, that triggers an email to a junior analyst to start reading.
Right, and grabbing a big cup of coffee. But with Box Automate, the upload itself triggers an automatic workflow. The system instantly calls Box Extract. The AI agent scans the 200 pages, ignores the fluff, and extracts the total net worth, the liquid asset value, and the tax identification numbers.
Boom, done.
Done. Once the AI has that data, Box Automate moves to step 2. It triggers a compliance check. A separate AI agent cross-references those extracted numbers against federal anti-money laundering regulations.
So the AI is checking the work of the other AI.
Exactly. Now, if the compliance check flags a high-risk anomaly, Box Automate pauses the autonomous process and routes a secure notification to a human compliance officer. The human reviews the specific flag page, approves it, and clicks a button.
And then what?
Box Automate instantly resumes the workflow, generating the final trust contract and sending it via e-signature to the client. The entire process, which historically took 3 weeks of manual emailing, document hunting, and back-and-forth phone calls, happens securely within the Box ecosystem in about 15 minutes.
That is insane. And crucially, the highly sensitive financial data never leaves the secure, encrypted Box environment to go to some random public AI server.
Nope, it stays completely governed.
Okay, I completely understand the value proposition for the customer, but I have a fundamental concern about the underlying business model for Box here. We really have to talk about tokenomics.
Tokenomics.
Yeah.
This is the heart of the AI software industry right now.
It is. So let's look at how fast the underlying AI foundation models are moving. OpenAI comes out with GPT-4. 2 months later, Anthropic releases Claude 3, then Google updates Gemini, and Meta open sources Llama 3.
It's moving at breakneck speed.
Right. The sheer cost of using these AI brains is dropping rapidly as the technology gets better, smaller, and more commoditized. Every CEO is terrified of their profit margins getting squeezed by the AI labs. Yeah. So if the underlying intelligence is becoming cheaper and commoditized, how does Box protect its margins? Like, why wouldn't their 40% premium eventually collapse as AI gets cheaper?
This is perhaps the most brilliant, subtle part of Aaron Levy's entire strategy. And it's something he spent a significant amount of time defending on the call. To understand it, we need to do a quick ELI 5 explain. Like, I'm 5'5" on how AI actually processes text, specifically regarding tokens.
Yes, please. I constantly hear analysts talk about token budgeting, but what actually is a token and why is it the most expensive part of this process?
Well, when you send a paragraph of text to an AI model like ChatGPT, the AI does not read words the way a human does.
Yeah.
It breaks the text down into chunks called tokens. A token might be a single word or just a piece of a word. A general rule of thumb is that 100 tokens equal about 75 English words.
Okay, so it's a unit of measurement for text.
Yes. And every time you send data to an AI, you pay a microscopic fraction of a cent for every token you input, and another fraction of a cent for every token the AI generates as output.
Okay, makes sense.
Now imagine sending a 500-page legal contract to an AI to summarize. That is hundreds of thousands of tokens. The computing power, the raw silicon processing power required to run the neural network over those tokens is incredibly expensive. For a large enterprise running thousands of these queries a day, their token budget, their monthly bill to OpenAI or Anthropic, can easily spiral into the millions of dollars. CIOs are terrified of these runaway compute costs.
Which brings us to Box's positioning as the universal adapter. How does this token mechanic play into their strategy?
Because Box is sitting on top of the data, acting as the neutral governance layer, they can operate as an agnostic routing system. Box is telling enterprises, do not hardwire your entire company's data infrastructure directly into OpenAI. Because what happens if, 6 months from now, Google Gemini releases a model that is 10 times faster and half the price? If you are hardwired to OpenAI, you are stuck.
Oh, you would have to rip out the entire plumbing of your corporate IT system.
Exactly. Box acts as the universal adapter. They handle the voltage difference, so to speak. By keeping the data secured in Box, the enterprise allows Box to handle the complex security, compliance, and API connections to the various AI labs. Box can literally swap out the underlying AI model without the end user ever knowing.
Wait, let me see if I grasp the economic genius here. Box can analyze a specific task requested by an employee, say, a simple request to extract a due date from an invoice. Box's system recognizes that this is a very simple task. It does not require the massive, expensive, multi-trillion parameter reasoning power of GPT-4. So behind the scenes, Box routes that specific token workload to a much smaller, cheaper open source model. The task is completed instantly, but Box just saved the customer 90% on the token compute cost for that specific query.
You nailed it. Box optimizes the compute cost for the customer, keeping their token budget under control.
That's brilliant.
But how does Box make money off this? Because Box charges the customer for its own AI units or consumption tokens. Regardless of which underlying AI model does the actual thinking, whether it's OpenAI, Anthropic, or an open source model, the customer is paying Box for the privilege of securely routing the data to the AI and back.
Oh, wow. So Box is essentially operating a highly secure toll road.
Yes.
And the cheaper the cars, meaning the AI models get, the more cars drive on the road, the more tasks employees automate, the more data flows back and forth. And Box collects a toll on every single API call and every single token processed across their secure infrastructure.
Exactly.
As the underlying AI compute gets commoditized and races to the bottom in price, Box's consumption revenue actually goes up because usage explodes. I mean, it is an absolute masterclass in incentive alignment.
The toll road analogy is highly accurate, but it's a toll road that guarantees the armored cars don't get robbed. It is the security layer that allows the consumption model to work in an enterprise setting.
And we don't have to just theorize about this. Management walked through specific, tangible proof points on the call, real contracts signed in Q1. Let's look at the U.S. wealth management firm they highlighted. What was the exact mechanism of that deal?
So this firm handles incredibly sensitive trust and estate documents. They adopted the Enterprise Advanced tier specifically to use Box AI to extract key metadata from unstructured legal documents. By doing this, Box became the trusted content layer powering their entire client-facing workflow.
Right.
The key word in that entire sentence is trusted. As we discussed with the Universal Adapter, you do not simply plug a billionaire's trust in estate documents into a public ChatGPT prompt. You need Box's enterprise-grade permissions, compliance logging, and data residency controls surrounding the AI interaction. Box guarantees that the data is not used to train the public AI models.
They also mentioned a massive European manufacturing company, right?
Right. This was a new logo win, meaning a brand new customer, not just an upgrade in Europe. This manufacturer bought EA to securely manage and share documents globally, specifically to move away from deeply fragmented legacy systems.
To get everything in one place.
Exactly. They needed a unified, highly secure content layer to reduce friction in their complex global supply chain workflows. If a supplier in Asia uploads a spec sheet, the manufacturing engineers in Germany need to be able to use AI to instantly translate, summarize, and extract the parts lists securely.
And then there was the most telling example of the quarter, a massive North American consumer finance company in partnership with a system integrator called Slalom. Break down why this specific deal is so indicative of Box's future.
This was a multi-thousand-seat deployment of Enterprise Advance. This finance company was previously using a horribly fragmented legacy stack. They had one system for basic document management, a totally different vendor for e-signatures, and a third proprietary system for document generation.
Which, unfortunately, is the reality for 90% of legacy banks today.
Exactly. And that fragmentation created massive compliance risks in their lending workflows. When data has to be manually moved between 3 different systems, human error skyrockets, and auditing the process for regulators is just a nightmare.
Oh, totally.
They realized they could not apply modern AI automation to their lending process until the data was unified. So they partnered with Slalom to completely rip out the old stack. They replaced it entirely with Box EA. Box now acts as the single source of truth, unifying the data so they can safely deploy AI agents to accelerate their lending approvals without running afoul of federal compliance.
Multi-thousand seats, entirely replacing the legacy stack, all at a 30 to 40% price premium. That is the precise mechanism of how you accelerate a $300 million quarter to double-digit growth. And, that leads us perfectly into the most important underlying metric of the entire SaaS business model, the net retention rate, or NRR. Dylan Smith reported that Q1 NRR came in at 105%. That is up from 102% a year ago.
A massive jump.
Now, for anyone who does not live and breathe inside SaaS valuation spreadsheets, what does an expanding NRR actually mean, and why is seeing it expand right now so mathematically improbable?
Net retention rate is the ultimate measure of a product's value. It measures how much revenue you are retaining and expanding from your existing customer base, completely ignoring any new customers you might acquire.
Okay, so purely the existing base.
Right. Imagine a hypothetical scenario where Box fired its entire marketing department and its entire new business sales team today. They never sign a single new company again. An NRR of 105% means that their total revenue would still grow by 5% this year, purely because their current customers are renewing their contracts and choosing to spend more money with Box than they did last year.
It is the holy grail. It proves that the product is sticky and the switching costs are high.
It is. But to your point, seeing NRR expand from 102% to 105% in today's macroeconomic environment is highly unusual. Right now, if you look across the software sector, most companies are seeing their NRR shrink drastically.
Why is that?
Because historically, the easiest way for a SaaS company to grow its NRR was just to wait for their existing customers to hire more employees. If a client company grows from 1,000 employees to 1,200 employees, they have to buy 200 more software licenses or seats.
It's the lazy sauce growth model. Just ride the wave of corporate hiring.
Exactly. But right now, the corporate hiring environment is dead. Companies are laying people off, not adding thousands of new employees. So if the sheer number of human employees isn't growing, how is Box extracting 5% more revenue from the same pool of customers?
Because they are upgrading them. It has nothing to do with selling more human seats. It is entirely about making the existing seat vastly more valuable.
Precisely. They are taking a customer who is perfectly happy paying $20 a month for a standard storage license and proving to them that moving up to a $30 a month Enterprise Advanced license will save them thousands of dollars in operational costs through AI automation.
Yeah.
Dylan Smith specifically noted on the call that while they are seeing a small amount of seat expansion, the massive NRR growth is heavily fundamentally driven by the EA premium. They are dramatically increasing the average revenue per user, or ARPU, by delivering exponentially more value through these AI workflows.
So Box has completely decoupled its growth engine from the corporate hiring cycle. They are no longer dependent on their clients adding headcount. They grow by increasing the capability of the client's existing workforce. I mean, that is a massively resilient business model.
It is the definition of high-quality growth. The AI monetization engine is not a theoretical slide deck. It is real, it is driving measurable adoption, it is built on a highly defensible universal adapter token model, and it is expanding their profitability.
Okay, the mechanics of Q1 are undeniable. The engine works. But investing is not about the past, it is entirely about the future. The stock market is a forward-looking discounting mechanism. As an investor looking at this transcript, my immediate fear is simple. Was Q1 just a lucky quarter? Did a few massive multi-thousand seat EA contracts just happen across the finish line in May, artificially inflating the numbers? Or is this a permanent structural shift in the business?
That's the million-dollar question.
To answer that, we have to meticulously scrutinize management's guidance. So what does this all mean for the rest of the year?
Well, the guidance is where management puts their credibility on the line, and they provided a very detailed roadmap for how they view the rest of the year.
Let's start with the immediate horizon, Q2 of fiscal 2027. Dylan Smith forecast Q2 revenue to be approximately $319 million. That represents roughly 9% year-over-year growth, or 10% in constant currency. Billings are expected to hit low double-digit growth, and the operating margin is expected to hold incredibly strong at 28.5%, with an EPS of 39 cents.
That is a very solid sequential step up. It proves that Q1 was not an isolated spike. They expect the top-line momentum to continue, and they expect that operating leverage to expand even further to 28.5%. They are getting more profitable as they scale the AI products.
But the much more important signal, the one that tells us how they view the macro environment for the next 12 months, comes from the full-year guidance. Management actually raised their expectations for the entire fiscal year. They raised the full-year revenue target by $5 million, bringing it to approximately $1.28 billion.
Now, to a casual observer, raising guidance by $5 million on a massive $1.28 billion base might sound like a rounding error.
It's tiny.
It certainly doesn't sound like a massive earthquake. But there is a crucial nuance buried deep in the transcript regarding that exact number that makes this raise significantly more aggressive than it appears on the surface.
Break down the currency nuance again, because this is where retail investors often miss the true underlying strength of a business.
As we discussed with the Q1 billings, Dylan Smith noted that they are facing a rapidly worsening foreign exchange headwind for the remainder of the year. The US dollar is stronger than they initially modeled. This means that for the next 3 quarters, every euro and yen they collect is going to be worth less when reported in dollars.
Right.
They are absorbing a massive, mathematically guaranteed penalty to their reported revenue simply because of global macroeconomic currency fluctuations.
But despite knowing they're going to take that currency hit, they still raise the absolute reported revenue target by $5 million.
Exactly. Dylan Smith explicitly pointed out on the call that if you normalize for those worsening currency movements, if exchange rates had just stayed perfectly flat, this is actually an $8.5 million raise to the underlying operational business expectation.
That is a critical distinction. The actual business, the software sales, the AI token consumption, the EA upgrades, is outperforming management's previous expectations by $8.5 million. But the strong dollar is masking $3.5 million of that outperformance on the headline report. And they didn't just raise the top line, they raised the profitability target as well, right?
Yes. They raised the full year EPS guidance to $1.56 or $1.64 in constant currency. When you adjust for that exact same currency drag, it represents a 6-cent underlying increase in their earnings power per share for the year.
Wow.
That tells you everything you need to know about the unit economics of the AI pivot. Not only is the Enterprise Advanced tier driving faster revenue growth than they modeled, but the flow through to the bottom line is accelerating. The marginal cost of delivering that AI token layer is so small that a huge percentage of that $8.5 million operational beat drops straight into net income.
Okay, so the verbal guidance is incredibly strong. They are telling Wall Street analysts that the pipeline is bursting, the AI products are sticky, and the profits are scaling. But there is an old cynical saying on Wall Street: do not listen to a word management says on an earnings call. Watch exactly what they do with their cash.
Put your money where your mouth is. Exactly.
Talk is cheap, but capital allocation is the ultimate lie detector test. What are Aaron Levy and Dylan Smith doing with that $128 million in record free cash flow?
They are buying their own stock aggressively and over fist.
Let's look at the sheer scale of the numbers here. Back in March, right before this fiscal year officially started, the board announced a massive $500 million expansion of their share repurchase program, and they did not wait around for a rainy day to use it. In Q1 alone, in a single 90-day window, they executed the buyback of 4.8 million shares for approximately $114 million on the open market. That leaves them with about $445 million in remaining capacity to keep buying.
A stock buyback of this specific magnitude, executed at this specific speed, is the ultimate undeniable signal of executive conviction. Let's explain the mechanics of a buyback.
Sure.
When a company uses its free cash flow to buy its own stock on the open market and retire those shares, they're physically shrinking the total pie of shares outstanding.
Meaning there are fewer slices of the pie to go around.
Exactly, which means every remaining share, the shares that a retail investor might currently be holding in their brokerage account, instantly represents a slightly larger percentage of total ownership in the company. More importantly, it represents a larger mathematical claim on all future earnings and free cash flow. It artificially but permanently boosts the earnings per share going forward.
And beyond the mathematical boost, it is an aggressive philosophical statement. It essentially means that Aaron Levy and Dylan Smith are sitting in the boardroom, looking at the public market valuation of their stock, looking at their highly confidential internal pipeline data for enterprise advanced adoption, looking at the massive consumption metrics of the AI token routing, and concluding, Wall Street is completely mispricing our business.
Yes.
The market still thinks we are a legacy digital filing cabinet. They do not understand the AI pivot yet. Our stock is fundamentally cheap right now, so we are going to use our cash to buy as much of it as possible before the market wakes up and the multiple expands.
Precisely. You do not authorize a $500 million buyback program and immediately deploy over $100 million of it in a single quarter if you think your core business growth is about to stall out.
Right.
You do not burn cash like that if you are worried about the macro environment crushing your pipeline. You do it when you believe with absolute certainty that you are sitting at the very bottom of a massive S-curve of technological adoption, and you know the internal data is vastly stronger than the external narrative realizes. The combination of raising forward operational revenue guidance and aggressively buying back your own stock is one of the most fundamentally bullish compound signals a management team can ever send to the market.
Which perfectly sets up the ultimate purpose of this deep dive. We have reviewed the pristine headline numbers and the escape from 3-year growth purgatory. We have relentlessly broken down the technical genius of the universal adapter strategy, the box extract alchemy, and the AI token consumption model. We have analyzed the highly confident forward-looking guidance and the aggressive capital allocation. It is time to deliver the final verdict. Based on the totality of this transcript, what is the actionable takeaway for you, the retail investor?
Well, if we connect this to the bigger picture, I think the conclusion is undeniable.
I am taking a firm, deeply opinionated stance here based on the data. I am bullish, capital B, bold, underlined, stamped. Bullish.
I agree completely. And if we synthesize the core why behind that bullish verdict, it comes down to the fact that Box has successfully solved what the entire software industry is currently calling the AI monetization gap.
Explain the AI monetization gap, because if an investor understands that concept, they understand the next decade of the tech sector.
If you look broadly across the entire software as a service sector today, almost every company falls into one of two dangerous categories regarding artificial intelligence. The first category views AI as a literal existential threat. These are companies built entirely on selling basic user interfaces for simple, repeatable workflows.
Okay.
They are terrified that a sophisticated AI agent will just learn to do that workflow autonomously in the background, rendering their software completely obsolete. They are playing defense.
Right. If an AI can generate a perfect expense report from a photo of a receipt, I don't need to pay a monthly subscription for an expense reporting software interface.
Exactly. The second category is companies that are desperately scrambling to add AI chat bots and copilots to their existing products. But here's the problem. They are struggling to actually get their customers to pay a premium for it.
Yeah, nobody wants to pay extra.
The customers view the AI chatbot as a gimmick, not a necessity. So these software companies are eating the massive multi-million-dollar computing costs of running the AI models in the back end, but their top-line revenue isn't moving. Their profit margins are getting crushed by the compute costs. That is the monetization gap. An incredible amount of industry hype, billions of dollars in capital expenditure, but very little actual incremental profit being generated.
And Box is the rare, glaring, highly profitable exception to that rule.
They are the anomaly. Box is actively, demonstrably, and successfully commercializing AI today. They're not just talking about a theoretical roadmap for 2028. They're charging a massive 30 to 40% premium for the enterprise advanced tier right now, and global Fortune 500 customers are happily paying it because it fundamentally solves the unstructured data bottleneck that is holding back their own AI ambitions.
Yeah, it's solving a real pain point.
Furthermore, their AI token consumption model, the secure toll road we discussed, means that as their customers inevitably use AI more heavily over time to automate complex workflows, Box's revenue scales automatically alongside it. They don't have to convince the client to hire more people. They just have to provide the secure routing for the AI agents.
So, the actionable advice. If you are currently holding this stock, or if you are considering starting a position in this company, this Q1 earnings call is your definitive proof that the underlying thesis has fundamentally changed. Box is no longer a slow-growth legacy cloud storage commodity competing on price against Google Drive. You have to take that old mental model, that old valuation metric, and throw it completely out the window.
It is entirely obsolete. Box is now a highly sticky, high-margin, critical AI infrastructure transition play. They are positioning themselves as the essential, neutral plumbing required for the enterprise AI revolution to actually function securely.
And the single most compelling piece of evidence for that transition is the fact that their commercial segments, their billings, and their net retention rates are all growing globally right now, despite an incredibly muted corporate hiring environment and severe foreign exchange headwinds. They have proven they can dictate their own growth by dramatically increasing the underlying value of each individual user through AI automation, rather than just relying on the old lazy sauce model of waiting for clients to hire more human beings. They are entirely in control of their own destiny. That is why the verdict is bullish.
It is a very clear, completely data-backed verdict. It is a textbook example of a successful, highly complex strategic pivot executed to perfection.
Well, we have covered a massive amount of ground today. Let's do a quick recap of the journey we just took. We started with the Q1 numbers, which were phenomenal, 11% revenue growth, breaking a brutal 3-year slump, massive operating margin expansion up to 27.7%, and a comprehensive beat across every metric. We explored the genius of their universal adapter strategy, showing how products like Box Extract and Box Automate are turning chaotic, messy, unstructured data into structured AI gold.
Yeah.
We broke down the mechanics of how they make money off token consumption, regardless of which AI lab wins the underlying model wars. We looked at the raised operational guidance and the incredibly aggressive $114 million stock buyback, signaling deep management conviction. And we delivered a firmly bullish bottom line based on their unique proven ability to actually monetize the AI revolution today.
It is a fascinating company to watch right now. But as we wrap up this deep dive, I want to leave a final, genuinely mind-bending concept on the table. It is something I pulled directly from Aaron Levy's closing remarks on the call, and it is something that every technology investor needs to deeply mull over.
Oh, I love these macro-level thoughts. Give it to us.
Levy noted on the call that we are rapidly entering a world where there are, and I quote, hundreds of times more agents than people in an enterprise. I want to just pause and really think about the sheer implications of that specific sentence. For the last 50 years of computing history, software has been designed almost exclusively for human eyes and human hands. It was built around graphical user interfaces, keyboards, mouse clicks, and dashboards.
Right. The entire paradigm, the entire way we price and build technology is based on human-computer interaction. The human is the bottleneck.
But if Levy's thesis is right, and if autonomous AI agents eventually do 99% of the actual interacting with a company's files, if bots are the ones reading the massive legal contracts, extracting the thousands of invoices, and running the complex compliance checks across global supply chains in milliseconds, what does that actually mean for the future of the software industry?
That's a crazy thought.
Is Box's primary end user about to permanently shift from a human employee sitting at a desk from 9 to 5 to an autonomous, invisible bot operating in the cloud? And if that is true, how do you even begin to price software for a robot that works 24 hours a day, 7 days a week, processes millions of documents a second, and never takes a vacation? It fundamentally shatters the economics of the technology industry as we know it.
That is a staggering, completely paradigm-shifting thought. If the primary users of enterprise software are no longer human beings, the entire per-seat, per-user licensing model that has dominated the last 2 decades of SaaS is completely dead. The traditional SaaS metrics will become meaningless. And Box's consumption-based AI token routing model might not just be a clever way to boost margins in Q1, it might actually be the foundational blueprint for how the next $1 trillion in software revenue is generated over the next decade.
It is a profound shift. We are watching the architecture of the enterprise change in real time.
It really is incredible. And that is exactly why we do these deep dives. Because underneath the dry, boring accounting jargon, the basis points, the constant currency adjustments, the ratable revenue recognition are the massive tectonic shifts that are fundamentally reshaping how the global economy works. Thank you so much for joining us on this exhaustive journey through the numbers today. We hope you walked away with a vastly clearer picture of the underlying mechanics of Box, the brilliance of their AI pivot, and the wider, rapidly evolving AI landscape. Remember to keep digging into the data, keep relentlessly translating the corporate jargon, and always keep asking the hard, skeptical questions. We will catch you on the next deep dive.